Welcome back to the deep dive. We're here to open up the filings, the notes, the investor call transcripts.
Yeah,
Basically give you the ultimate shortcut to getting smart on a company.
that's right.
And today, we are diving deep into McDonald's Corporation, specifically their Q3 2025 performance and the strategy they're betting on.
Yeah, it's a really fascinating situation because McDonald's is navigating, well, let's just say a very tricky economy right now.
Mhm.
So our mission here is to unpack this paradox. They delivered really solid global growth numbers. Global comparable sales up 3.6%.
Mhm.
Global system-wide sales up 6% in constant currency. And they hit, get this, $4 billion in restaurant margin dollars for the first time ever.
Wow. Okay. First time ever.
But they did this while the consumer base is, and this is their CEO's phrase, highly challenged.
Right. That's the core conflict, isn't it? That's the tension we really need to get into. How do you keep pushing profitability, those margins, while also, defending your spot as the leader in affordability?
Especially with inflation just sticking around, hitting everything. Rent, food costs, beef prices.
Exactly.
So I think we have to start with the U.S. consumer data, because that's where you really see the friction. Chris Kempczinski, the CEO, was super clear about the split reality they're facing.
Yeah, the data he shared was, honestly, it was startling. It paints a pretty tough picture of the economy right now.
Mm.
He said QSR traffic from lower-income consumers,
Mm-hmm.
the customers who traditionally rely on McDonald's for cheap, reliable meals, it's declining by nearly double digits.
Nearly double digits. And crucially, that's not just a blip. That trend has been going on for almost 2 years.
2 years, that's significant.
It is. And here's the other side of that coin, the bifurcation. In total contrast, QSR traffic growth among higher income consumers, that was actually up nearly double digits in the quarter.
Wait, hold on. So the people who are maybe feeling the financial pinch the most are visiting less, but folks with more disposable income, who you might think would go, I don't know, fast casual or sit-down places. They're actually going more.
That's the puzzle they're dealing with. They seem to be losing some ground with their core affordable customer base, while at the same time capturing people who are looking for a cheaper alternative to, say, casual dining.
So trade down at the higher end, but maybe trade out at the lower end, people just cooking at home more.
Exactly. That seems to be it. Trade down versus trade out. And McDonald's leadership, they're cautious. They expect these pressures on the lower income consumer. They think that's going to continue well into 2026.
Okay, so if that's the landscape, their main response has got to be defensive, right? Aimed squarely at winning back that lower-income customer.
Precisely. And that's why this relaunch of the extra value meals, the EVMs, is just so critical for them right now. Because these aren't just, random deals of the week. The EVMs hit the core menu: burgers, fries, nuggets. The stuff that makes up, 60% of their total sales mix.
Right. And I guess, while app deals and loyalty offers are important, people probably judge your real value based on the menu-doored prices they see every day, not just a temporary digital offer.
Absolutely. That everyday perception matters most. And the EVMs, they account for about 30% of all U.S. transactions. So they're fundamental to that value promise.
Okay, let's talk specifics. What EVMs did they actually launch? They started in September, right?
Yeah, September saw the $5 sausage McMuffin with egg meal and an $8 Big Mac meal.
Okay, breakfast and lunch, dinner.
Then, come November, they switched it up. It became a $5 sausage, egg and cheese McGriddles meal, and an $8 10-piece chicken McNuggets meal.
Huh. So swapping items like that, is that just testing? Seeing what pulls people in? Especially maybe breakfast versus chicken?
It looks like dynamic testing, yeah. Not just the price point, but the actual product mix. Trying to figure out what drives volume, especially in breakfast, which is, super competitive. But the core idea is the same. A full meal, specific price, competitive.
And success isn't just about sales lift, is it?
No, definitely not. They said they're tracking two main things. First, are they actually gaining back share among those lower income consumers? Are those traffic numbers improving?
Right.
And second, are their overall value and affordability scores improving? How people feel about their prices. It's a very calculated push to rebuild a perception that's frankly eroded a bit over the last couple of years.
Which brings us to the cost. Because if you're pushing deeper discounts when your own costs are rising, somebody has to absorb that, right? And it sounds like corporate is stepping up, at least temporarily. Let's unpack that financial side.
Yeah, it's a pretty significant investment, really designed as a short-term hit to corporate margins, specifically to help the U.S. franchisees. First up, there was an extra $40 million in marketing spend.
Okay, Just to get the word out about the new EVMs.
Exactly. Make sure everyone knows. But then there's the discount adjustment itself. This is where it gets interesting.
Uh-huh.
Before this relaunch, the average discount on an EVM across the U.S. system was around 11%.
Okay.
McDonald's essentially mandated a minimum discount level of 15% for these new EVMs.
Whoa. Okay. From 11% average to 15% minimum. That's a big jump. That must hit the franchisee's bottom line directly.
It does. That 4+ percentage point difference comes straight out of their profit margin on those meals. So this is where corporate stepped in with some serious co-investment.
How serious?
They are covering 50%, half of that effective menu price reduction, and that runs through the end of 2025.
Half.
Yep. That co-investment is expected to cost corporate about $75 million just in the fourth quarter of 2025 alone.
Wait a minute. Let me get this straight. McDonald's corporate is essentially paying its franchisees tens of millions of dollars so they can offer cheaper meals for a few months. That seems like the real headline here.
It's a huge subsidy. You could almost call it a targeted stimulus package just for their own system. But, and this is the crucial part, the timeline.
Right.
This specific 50% support continues through the end of 2025. It changes slightly, but continues through Q1 2026. And then it stops completely.
Okay, but hold on. If the CEO himself said they expect the tough consumer environment to last well into 2026,
Right.
isn't this just like kicking the can down the road?
Yeah.
Aren't they potentially sticking franchisees with the full cost of that 15% discount right when things might still be really hard?
That's absolutely the critical risk here. The stated goal, the strategy from management, is to, quote, bridge them through the most difficult part.
Bridge them.
Yeah. The belief, or maybe the hope, is that these EVMs will generate enough incrementality, meaning they bring in enough new visits, enough extra volume, that they become self-sustaining. Profitable for the franchisees, even with the lower margin per meal. By the time corporate pulls back that funding in Q1 2026, the volume has to make up for the lower price.
So it's a volume bet, a bet on customer flow. If enough people come back because the EVMs, the gamble works.
That's it in a nutshell. And, if you connect this to the bigger picture, it's really about predictability. They've done similar things internationally. Like, they locked in the price on the McSmart meal in Australia for a whole year.
Oh, okay.
That kind of certainty gives consumers confidence, especially when the economy feels volatile. And that's the certainty they're trying to rebuild in the U.S. with this EVM structure. Predictable, affordable meals.
Okay. So they've got this big, expensive program to defend their core value customer. Now, what about actually growing beyond that defense? That takes us to the accelerating the arches strategy, right?
Yeah.
Menu, digital innovation.
Exactly. This is the offense. While they defend the core beef, they've set up these new dedicated teams focused on high-growth areas. Chicken, beverages, and also beef innovation itself.
Makes sense.
And when you look at chicken, it's kind of a no-brainer. Globally, the chicken category is twice the size of beef.
Twice the size.
And it's growing faster.
So the snack wrap return in the U.S. back in July, that fits right in.
Yeah.
And it seemed like a massive hit. What was the price point again? $2.99.
Yeah, very sharp, 2.99 cents. And the adoption, huge. They said nearly 1 in 5 McDonald's customers bought one in just the first 4 weeks.
1 in 5. That's incredible. That's basically a huge customer acquisition event right there.
Totally. And it just reinforces that idea. You need the right product at the right value. They're pushing chicken globally, too. Things like the Chicken Big Mac in the UK, McWings in Australia.
Yeah.
They're seeing real traction, diversifying beyond beef.
Okay, let's pivot to beverages, because this seems really interesting, especially with the learnings from their Cosmics concept potentially influencing the main stores. This feels like their path to recovering some margin.
I think you're spot on beverages. It's a global category worth over $100 billion. And crucially, it's growing faster than the overall restaurant industry.
And margins are good.
Margins are typically very good on beverages. Much cheaper to produce and serve than, say, a burger. So yes, this can help offset the lower margins they're taking on things like that $5 EVM breakfast.
They launched a big test, right? Colorado and Wisconsin.
Yep, over 500 restaurants back in September. And the product mix is key. Cold coffees, fruity refreshers, fancy sodas, energy drinks, stuff like that.
And the results?
Exceeding expectations, apparently. And here's why it's working. They say it's driving incremental occasions. People stopping by just for a drink, maybe at different times a day.
Not just adding a drink to a meal order.
Exactly. New visits. And they're seeing a higher average check, likely because the drink is often an add-on purchase during a meal occasion, or it's a premium drink purchase on its own. It's a very deliberate strategy. Grab share in beverages, price it competitively but profitably, and drive that margin growth they need.
Got it. Okay, quickly on the other growth pillar. Digital. Sounds like that's moving along well, too, especially with Monopoly coming back.
Oh, yeah. Monopoly in the U.S. in October, first time in nearly a decade. They called it one of their biggest digital customer acquisition events ever.
Really?
Yeah, drove a ton of app downloads and registrations, which is vital because they now have about 45 million 90-day active digital users in the U.S.
45 million.
And those loyalty members, they're known to be more engaged, they visit more often, they spend more. So Monopoly just feeds that whole digital flywheel.
Okay, let's zoom out globally for a minute.
Yeah.
While the U.S. is dealing with this, consumer split, the international divisions actually look pretty strong.
They really did perform well. The international operated markets, IOM, were up 4.3%. And the international developmental licensed markets, IDL, up 4.7%.
Any standouts?
Germany was a big one in IOM, delivered its strongest comp sales result in 2 years. They've been gaining market share there for almost 4 years straight, partly thanks to campaigns like Taste of the World. Australia also gaining share.
And in the IDL markets.
Japan was the leader there. They've had positive guest count growth for almost 2 years running now, which is impressive.
But even with that international strength, you can't escape the big global headwinds, right? The macro challenges.
No, absolutely not. The war in the Middle East, they noted, continues to negatively impact system-wide sales, particularly affects those IDL markets, which have significant operations in the region. That's just an external pressure, a geopolitical thing you can't discount your way out of.
Mm-hmm. And China. We heard things are tough there, too.
Yeah, China's complex right now. Their comparable sales are positive, and McDonald's is gaining share, which is good. But the overall market is facing major macroeconomic pressure. There's even a fierce delivery price war happening, which is pushing prices down. It's a deflationary environment.
Wow, deflation. Opposite of what we see here.
Right. But even with those difficulties, McDonald's is still all in. They plan to add 1,000 new restaurants in China just this year, playing the long game, focusing on volume.
Okay, let's bring it full circle back to that core issue, profitability and inflation. Despite the solid quarter, they're still warning about above-average inflation next year, especially for key items.
Yes, they were very clear on that. Specifically called out seeing very high inflation around beef prices compared to historical levels.
And beef is core.
It's their core product, which just reinforces that comment from the CEO that they just have to grind it out, maintaining that pricing discipline, being careful, while also pushing value so aggressively with the EVMs. That's a really tough needle to thread.
So if we try to boil this whole deep dive down,
Yeah.
what's the single biggest message McDonald's seems to be sending? What's the core strategy?
I think it really comes down to guest count-led growth. That seems to be the mantra. Both the defense, EVMs, and the offense, chicken, beverages, are ultimately aimed at getting more people in the door more often.
Right.
That EVM investment, it's a deliberate short-term hit to profits. But the goal is to secure long-term volume, because if they get the customer flow back up, and those customers are maybe buying those higher margin drinks, coming back regularly because of the loyalty app, that volume ultimately drives higher average unit volumes, AUVs.
Okay, let's just quickly define AUV for everyone. What does that mean for the system, particularly the franchisees?
Right. AUV is average unit volume. It's basically the average annual sales for a single McDonald's restaurant. So higher AUVs mean more money flowing through each restaurant. Which means better cash flow, better profitability for the individual franchisee, and that strengthens the financial health of the entire system. So more volume leads to higher AUVs, which keeps the franchisees healthy and invested.
Got it. That makes perfect sense. So summarizing, McDonald's is tackling this 2-year decline in lower-income traffic head-on. Big discounts, major corporate subsidies for a limited time.
Yep, the defense.
While at the same time, they're innovating in higher growth, potentially higher margin areas like beverages and chicken to capture maybe higher income folks, and just new reasons to visit.
The offense. It's definitely a high-stakes balancing act, margin versus volume.
A delicate balance for sure.
Yeah.
And that really leads us perfectly into our final thought, something for you, the listener, to maybe mull over. Given that inflation is sticking around, especially for core stuff like beef, how long can McDonald's really sustain the predictability of these attractive EVM prices? At what point does the pressure to protect restaurant margins force them to maybe pull back on that everyday affordability they're working so hard and spending so much to reestablish right now?